All right, so in this video, we're going to talk about wicks and shadows. So wicks or shadows are these sticks that come off the candlestick bodies. They are indications of rejected price. Okay, we know about candlestick bodies being these full red or green sections, and the wicks slash shadows, both the same thing, different name, are the sticks that come off of them. Okay, so that is what we want to focus on for this video, and I'm going to show you what they show and how we can use them to our advantage. So simply put, wicks I'm going to call them wicks, not shadows. That's what I call them myself, but they do have the same name. Wicks show rejected price. So when we see these sticks, we are seeing rejected prices in the market. Now, for example, if we were to look at this point here, this top area, we can see then that the highest point the market closed in, up in these highs, was 0.91330, we'll call that. 0.91330. So here we saw closure, rejected, closure, rejected, and then the market fell off. So 0.91330 was the highest point that the market actually got to before rolling over from this point. Okay, but we can see if we actually look over that key level, over that area, we see 1, 2, 3, 4, 5, 6, 7, 8 wicks that pierced over that level. So 8 attempts to go higher than that closure level that we got. Now, what this means is the highest price point that we could get to was 0.91330. But regardless of that being the highest closure point, the market did attempt to go higher numerous times. But all of the price was rejected and pushed back down, never actually managing to close over that level. And then that pushed us to the downside. So it shows us rejected prices, okay? And they can be used in numerous different ways, and reading these rejected prices can help us in various ways in the market, both bullish and bearish, and also to indicate indecision. So let's actually start with looking at the example we just plotted out there, and I'll show you how exactly the rejected prices, the wicks, can be used to identify downside is probably going to commence. So if we look at this 0.91330 level, we saw that price attempted it, we've said now 8 times, okay? And then what was actually followed by that was a big drop to the downside. Now, this is very useful because it shows us that this level, okay, is actually a key resistance point. Now, seeing so many rejections above it and absolute failure to close above it shows us that there's so much selling pressure in this area. It means that these sellers are waiting. The liquidity that we spoke about earlier, the liquidity is above this level. And all of these taps over are essentially fulfilling the liquidity. So should we trade into this zone, we've got so many sellers, so much selling pressure waiting there, ready to push the market down. And now seeing 8 failures to close above the level, like we've seen here, is a great indication that the market is probably not going to get that high and is indeed ready to fall down soon. So when we see these 8 wick rejections, while this may not provide us with an immediate selling opportunity, when we see this push down, okay, when we see the changes in structure, right, higher low, higher low, higher low, lower low, and then lower high, when we see this change in trend structure like that, followed by all of these wicks, or following all of these wicks, that is then going to show us that, yeah, maybe this market is ready to turn down, okay? So wicks are not going to provide us, in most circumstances, with an immediate selling opportunity. However, what they will do is show us that, okay, a specific level has got so much pressure above it that if we do see a reaction from here, we're probably going to move down in that reaction direction. So let's find another example like that. So we need to find a flat bottom in the market. Right, here we go. This area here, we see the market came down numerous times. The lowest level that we managed to close here was 0.89480. Okay, so the market never closed beneath that level. However, it did actually attempt to go beneath that level 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. And then after the 10th reaction, we saw a big bullish candle which closed us over the whole little consolidation area that we're currently in. So this closed higher than 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 previous closures, right? Well, 12. We even closed higher than this closure. So this candle has now actually taken out these 12 hours of price action. after we saw 10 wick rejections. So what's that? 10 attempts to go lower, pushed back up, showing immense buying pressure beneath this level. So then when we see a reaction the other way, that is then a good indication that the market is ready to go that way, because we know that there's so much pressure pushing the market in this direction. So seeing off resistance, off support levels, the closure points of the market, seeing these big wick rejection buildups is a great way to indicate whether or not the market is going to go the next way. Now, what can actually be useful on the other side is if we saw closure beneath this level, that would have indicated that the buying pressure was then weakening, okay? Because we've actually managed to see the price push and close under the level that has been failed 10 times. So seeing a push and close beneath this level and beneath some of these wicks could then indicate that the market's ready to go this way. So it's cool to actually be able to read the wicks in the market. And it's very, very interesting, very, very useful for gauging where we might find market reversals. So that's one way to use wicks. Identifying areas where the market is losing strength or losing its weakness and is ready to potentially reverse in the opposite direction. So another way that wicks are useful is to identify indecision in a market, potential exit points if you are already in a trade, or potential areas where the market could reverse. So for example, if we look at an area like this area here with a lot of wicks either way, boxing this consolidation off, what do we see? Wicks there, wicks there, wicks there, wicks there. Wicks all the way down here. The lowest closure there. The highest closure there. So we saw 1, 2, 3, 4, 5, 6, 7, 8 attempts to go higher that all failed. 1, 2, 3, 4, 5, 6, 7, 8 attempts to go lower that also all failed. So the market here is in an area of indecision. We've got attempts to go higher, attempts to go lower, all being pushed back. We can't actually manage to breach that low, and we can't manage to breach this high. So this shows indecision in the market. Now, what this might do is say you are selling into the market and we hit this big phase of indecision and we see the market moving so sideways like this. This could give you indication maybe you should get out of your trade. Maybe you should take some profits, because we're obviously in a state of limbo now. And when we're seeing a failure to go higher and a failure to go lower, that shows indecision. And that means that when we come out of this indecision, the market could go either way. So indecision is useful really for giving us the points where we should probably be looking to lock in some profits. And it's also going to be useful for, okay, maybe if we are not in the market yet and we see the market enter this phase of indecision, we could look to see, is the market going to push below? That could provide a sell. Or is the market going to push above, which in this instance it did, and that could then provide a buy. So if we look at this example, we have the 1, 2, 3, 4, 5, 6, 7, 8 wicks over the price, all rejected prices. If we then see the market pushed and managed to close above, right? It managed to close above in these areas that were previously not able to close within. So 8 failed pushes up have now been succeeded with this positive and what's the word? This successful push above, so to speak. So the closure here shows that the successful push in the market has actually taken out all of these rejections that we saw before. So that could then provide us with an opportunity to actually buy, because we see that all of these previous wicks, all of these previous rejections have been overcome, and the market is now ready to go up. So reading indecision in the market can be useful for then finding, right, which way is the market going to break out? Which way is the market going to push? Now, if it pushes above, we could look at that for a nice buying opportunity, and likewise. So if we look at this previous consolidation area, this shows the flip side of it. We have closures no higher and closures no lower than these two levels, this box consolidation. Now we've seen 1, 2, 3, 4, 5, 6, 7 wicks beneath, 1, 2 wicks above. So we've seen attempts to go either way, indecision in the market. Now when we see this bearish closure candle, that then provided us a selling opportunity, okay? We even had then a pushback, retest, and then we could have sold the market down until we saw, okay, more wicks, more indecision. So that is how wicks can be useful, right? We are looking at them as rejected prices and seeing, okay, is the market going to build the strength to actually close one way or the other past these rejected prices? Or is it actually going to respect the rejected prices and then continue to push up? For example, in this instance, if we saw this consolidation with all of these, was it 7 failures to push beneath? If this was then followed by a bullish candle which closed above, that could have then indicated that, okay, the selling pressure here is dead. We've seen 7 attempts to go lower, and they've actually all been pushed out. And now that we've seen this strong bullish momentum candle, we can then look to take the market higher. So we're essentially just trying to view the rejected prices in the market to see which way the strength is building up. So some other ways that we can use Wicks, just to recap then, we want to use them to identify areas of indecision and areas of reversal. So if we're seeing the market fail to close higher than a specific level, and then we see the market begin to push down, that is then going to indicate that we can sell. Not from the Wicks, but using the Wicks as a big important confluence to show us that the market doesn't have any strength. On the flip side, if we're seeing a lot of Wicks to the downside, we can see that the market is failing to close beneath a specific level, and then we see a bullish push up. That could then provide us with a buying opportunity because we're seeing, okay, there's so much buying pressure in here, all this price is being rejected time and time again, and now that we're actually managing to close in the other direction, it shows us that this buying pressure in this point is pushing the market up, so we can get in and buy in line with it. So that is the main ways to really use Wicks. Now, there are a few Wick patterns that we can use, which I will talk about in future videos. But for now, that is what you need to use them for. Finding both indecision, where we have Wicks both ways, and then, of course, selling or buying pressure. For example, if we are seeing these Wicks like this, we know that the market is probably losing its selling pressure and is ready to actually make a move back up. And then on the flip side, we see the market move up and then all these Wick rejections coming into the market. When we then see it starting to push down, we could actually be ready then to sell in line with it. So Wicks can be quite important. Wicks alone are not too much. However, Wicks, when used in line with everything else, can be very, very important and very useful to actually catch trades in the right direction. So in the next video, we're going to talk about indecision, and we're going to talk about a few indecision candles that are entirely made up of Wicks, or mostly made up of Wicks. So that's going to show you the indecision side of Wicks and how we can actually use individual candles to identify indecision and catch trades in one direction or the other by using them. So I'll see you over in the next video to talk about indecision.